Hi, welcome back to another episode of the Balance Sheet Breakdown, a Wilkin and Gunn Plan podcast. Today on the Balance Sheet Breakdown, we're going to be talking about considerations for your year-end accounting. I'm Chris Frederick, a partner with the firm, and joining me is my co-leader of our CAS department, Juan Arana. Juan, thanks for being on another episode with us.
Yeah, Chris, thanks for having me.
So I think the main goal of today, right, as we get to the end of another year, is to talk about what companies should be doing to prep for the end of the year, and how to maybe be a little bit proactive. So the start of the new fiscal year isn't maybe as big of a task or as big of a challenge as it has been for some folks in the past. To me, right, I think there's a couple high-level areas we're going to talk about, some things that can be done proactively this year, some other items to consider, and then, hey, how can we set ourselves up for success going into next year? And so, to me, maybe what we do, I think, day in, day out for a lot of our clients is that basic reconciliation work. What do we do for the clients that we do it for, and what do maybe you expect to see, as businesses wrap up the year? What should they be doing?
Yeah. So I think when it comes to, year-end, year close, kind of see two buckets. There's your traditional close that happens throughout the year, every month, quarterly, depending on your cadence. And there's some non-traditional items that you should definitely consider at year-end and account for. But if we're talking about just the traditional items, right, we go down the balance sheet, right? You're closing the books for the year. So you need to have all your cash accounts reconciled, your credit card accounts reconciled, depending on the basis of accounting that you follow, or your balance sheet accounts should be adjusted, reconciled, and you should have supporting schedules for everything. You should have sign-off, and then once you go down the balance sheet, let's say you finish cash and you go to accounts receivable. You do your steps through closing receivables, make sure everything's collected, make sure you estimate for things that shouldn't be collected. And you want to start closing out your books. And actually closing the books, password protecting, so things don't change after you sent reports to the preparation of tax returns for your accountants to do the audit. You want to start closing the books. And then you just continue going down the balance sheet, making sure everything's reconciled. We talk about prepaid expenses, prepaid insurance, making sure that your balance sheets are adjusted for interest on the P&L. That everything agrees to the ending year balance statements. Now, of course, this is something that we do on a monthly basis, on a monthly cadence for our clients. But if you are a founder that you've been kind of running on your own, or if you wait towards the end of the year to do all these things, I would say start around this time of the year and not wait until the very end.
To your point, there's maybe a couple of accounts that maybe get forgotten. To me, inventory is a real big one. And so thinking about having a good set of books, especially for year-end tax prep and tax planning, getting fair representation of what's on the P&L is super important. If it can be started here now and not wait till January, February, when there's really nothing else that can be done that would impact that prior tax year, is really important.
Yeah, I would say inventory is a big one, because if you don't have your proper inventory evaluation and count at 12/31, you're not going to have a proper cost of goods sold. And if you don't have a proper cost of goods sold, then you're not going to have a proper net income, and that can really mess things up. So I would start planning. If you haven't done an inventory count, it's good practice to do so minimum once a year.
Yep.
And you start thinking about that now, because you really want to do the count as close as you can to the year end, which is 12/31. Now, if it doesn't happen on that day, that's fine, right?
Yep.
But you want to be as close as possible to that day.
Right. And then thinking about, hey, fine, we've gotten past the standard accounting work. I think we see more and more, especially with some of our startups that are taking investments, that there are sometimes off balance sheet items that transactions that have happened, but maybe that haven't been addressed in the accounting, right? Yeah. And so there's a couple of those, I think, that make a whole lot of sense to really understand. Most likely that can be done now, so that you're set up for the end of the year.
Yep, and you really should be having conversations with your accountants throughout the year as things happen. But if you didn't, right, a common one that we see is when new stocks or stock options are issued to employees. They don't necessarily have to be exercised to the employees, but if they're issued, we kind of need to know that. I would say when it comes to investments, I've seen where, somebody sends a safe investment, let's say a couple $100,000, right? But they don't actually send cash. They're given that investment in lieu of services, right? So there's no cash leaving the bank account or coming in the bank account. So that's what we considered an off-balance sheet transaction, and we wouldn't know of that unless we have those type of conversations.
For sure, and bringing those things up sooner than later is super important. And maybe jumping around a little bit, thinking about stock options, right? It's not just about the ones that were issued. If there were some stock options that vested, there's a few different ways to deal with that too.
Exactly, and then if you're following GAAP, right, there's certain stock-based compensation expense that needs to be recorded. So yeah, these are really conversations that you should have throughout the year with your accountants, but at the very minimum, start having planning meetings around this time of the year as it gets close to December, so you're prepared, so the accountants know what's coming and that you have the proper backup to provide your accountants so the books can be closed on a timely manner and nothing is missed.
Yep, for sure. And thinking about additional preparations that are important to the accountant, it's what did the tax preparer ask for last year that they're going to ask for again, right? I think something that I know we ask for all of our clients, sales by state, right? If it's not all within the state that you're here, operating in and incorporated in, sales by state's important, payroll by state, and so being a little proactive, I think, will the year end a little easier. Yeah,
exactly, and that's a big one because you record sales and you just go out throughout your year. You worry about collectivity, you worry about revenue recognition, right? And once a year, they have, the tax department needs to make a determination if you need to file taxes in different states, right? And some of the components of that is what are your sales by state and what is your payroll by state, your own payroll. So, of course, you can run reports out of ADP if you have, specific payroll providers, Rippling, JustWorks, whatever that might be. But you want to be ready, especially the sales by state, because we've seen clients where they don't necessarily track sales with that level of information. So they're going to have to go back, let's say 9 months, right? If we're starting to have these conversations, fairly new client, and we have these conversations around this time, then we're going to have to go back at the beginning of the year, which could be a little stressful when everybody has other activities that they got to do by year end. So definitely have those conversations now and then plan about the future. All right, if you had to do a manual exercise today, what can change in the way that you record your transactions for next year, so with a click of a button you can run those type of reports.
Right, and be ready for that year end.
Yep.
To me, the next big thing for year end, it's something it's got really tight deadlines and timelines. 1099 reporting, right? That's hey, happy new year. You got a tax form due in 30 days.
Yes. What's painful about that, and I'm not sure if I'm using the correct word, but there's a lot of times where we get new clients at the end of the year and they didn't prep throughout the year to gather the required information and make the assessment of who should be receiving a 1099. So one of the things that we recommend, if let's say you started a new company, right, and it's really nothing material, you don't need an accountant just yet, but you want to start doing things right and laying the foundation. What you want to do is, as you hire a new vendor, right, and if it could be anybody that provides professional services, right, regardless of what they do for you, just get a W-9, because the W-9 is a form that gives you information about who you're entering into a partnership with, right? They're providing services for you. But it also gives you the required information to make that determination if they are required to get a 1099. So if you just make that a best practice, hey, new vendor, always get a W-9, just even file it, right? You can go through the rules, right? You can go through the rules. There's rules to see if this vendor gets a 1099 or not. But at the bare minimum, if you just get the W-9, file it. At the end of the year, when you speak to your new accountant or accountant, you have the information that you need, and you don't have to go asking for somebody that provided a service to you Q1 of the year.
I think what you just described is I think the struggle that a lot of businesses run into, right, is they've engaged all these service providers throughout the year because it was important and necessary to run their business. You've engaged a new law firm to do contract review back in February. 1099 reporting isn't always on the front of mind. And with the tight deadline and timeline, it's tough to wait until January 10th to start asking around for that stuff.
Yeah, and is it possible? Yes, it'll require work, but if you're in this time of the year, take a look at your volume of transactions. If you had a lot of volume of transactions, you pay a lot of people, you better start now if you haven't, got the 1099, W-9s.
Get those emails out.
Right. If you have a handful of people that you pay for services, okay, you have some breathing room. Don't panic. And start asking now.
Yep. We touched on stock options earlier, right? And so thinking about those vested stock options, hey, that's some more transactions that might need to be reported. Maybe it's on W-2, maybe it's on something else. But again, the reporting for those, the timeline's short.
Yeah, so that one, it's either included. So, there's various stock options. So you really have to see which stock options you're offering. And depending on the stock options, certain things need to go on a W-2, or certain things need to be reported on forms that need to be filed by 131, similar to 1099s. So, yes, start talking about that now. Start having conversations with your accountants. You definitely don't want to miss a W-2 deadline. You have a little more time for your 131 deadline, and that's Form 3921. In addition to just the accounting aspect and recording the expense, you also have some filing requirements that comes with stock options and giving stock options to your employees. And I think one of the biggest things that we see often is a lot of our clients use Carta, right? We love Carta. And it helps facilitate the stock options, the issuance of the stock options, or the document management, your cap table. And Carta can do the filing for you, but they need a certain code that your company needs to get from the IRS. I believe it's the TCC code. Unless you apply it, unless you have the code, then Carta cannot facilitate the filing. Now, the nice thing is that they can still produce the form and the information that you need. And then if that's the case, if you don't have that code, then you can reach out to an accounting firm, your accountant, or you can also explore softwares that can do the filing for you.
Right, and I think the big thing there is an ounce of proactivity is a pound of cure. And so thinking about, hey, great, we're all set up for this coming year end. We've closed the books. We're set for what we think the tax preparer is going to ask us for. We're ready for our 1099 filings. Looking forward to next year.
Yeah.
So something that I think we've seen companies be kind of all over the map with is budgeting. What do you expect for next year? Where do you start?
Yeah. So definitely now is the time to start. If you could do it a little earlier, but now it's also a perfect time to start. And when it comes to preparing your budget for next year, or a forecast for next year, right? You really start with a forecast and convert it into a budget. But you want to start thinking about who your audience is. Who is the budget or this forecast for? Right? If you're having it internally, it's for your internal purposes, you can get away with a P&L budget, right? And then for that, you can have resources. You can look up resources online. You can do templates, right? And it can guide you on how to do it, right? And you can start with, let's say, your revenue, right? From there, you go with your head count, right? And then you map out your cost of goods sold, your other expenses, right? Your operating expenses, and you go into your other income and expenses, right? When you have a cash basis P&L, that could be pretty straightforward to do. You might require a little assistance, but hey, you might be able to get away with that on your own. Now, if your audience is, let's say, venture capital, right? Because you're going for an investment, they might ask for, in addition to the P&L, three-way financials, right? Now you're talking about a forecasted balance sheet, an actual statement of cash flows. Now, for that can get a little tricky, and that's something that we don't recommend that founders or owners do themselves.
That's heavy accounting.
Yes, unless they're accountants or they're FP&A professionals.
If they got a good internal team, great.
Yeah, exactly. So if that's the case, then you might want to engage your accountants or FP&A professionals to help you with, right? And of course, they use tools to help with that, right? Because Excel is great, right? But if we want to automate certain things, we go with a tool. And then what's nice is that once that budget, the annual budget is created, you can then use that budget and can use it to forecast certain things and then meet on a regular cadence, right? So you don't have say, hey, every monthly, I want to just look at the forecast where we end up, maybe do a little modeling. And that's when founders and business owners really start dialing in and understand where they can improve or what can they do or not do to really drive up profits or get them to the goal that they want to be by the end of the year.
Yep. Yeah, no, I agree. Typically when businesses that we work with have budgets, whether it's full budgets from the top line all the way to the bottom, or some sort of sales budget, sales targets, that typically leads to another tool to better run your business. And so it's not just, hey, the static numbers as they are, year to date in the next year's financials. It's, hey, we all have expectations for what the year looks like, and it's helpful to have that benchmark.
Yeah. And then what also we've seen some founders and business owners, they have a good grasp on their financials and their finances, and they have a budget, but that budget might not necessarily be in the same chart of account structure that it is in their reporting software. So what we do with them is we kind of sit with them a couple of meetings, and we help take what they already created, try to poke a little holes, right? Because we want to be able to help. But if everything's good, then we just put it in the different buckets so it can be loaded into your accounting software. Exactly. And once that's loading in your accounting software, you could easily report actuals versus budgets.
Yeah, right. Which is a super helpful tool. That, to your point, set up ones at the beginning of the year gives you that ability for the whole year. And so, I think that's kind of a good transition, right? Talking about having a bridge between the chart of accounts in your accounting software to what you have in your budget. I think we always look at the end of especially when your fiscal year is the calendar year, but at the end of that fiscal year, it's a great time to take a look at what you've got going on internally, right? If you're going to switch a payroll provider, the easiest date, the most convenient date to do that, January 1st.
Yes.
Same thing with accounting software. It's great to have a go live date of a new accounting software, January 1st. It gives that really dark line in the sand to say, hey, listen, this is what we're doing. This is when we're doing it.
Yeah, absolutely. When it comes to payroll, you got to remember there's taxes that you pay throughout the year that they go to a certain threshold. Right? There's taxes that you pay throughout the year if it's the same entity, right? If you have various entities and you're thinking about maybe moving payroll to different entities, those are things that really should happen at 1/1 because that's when the clock resets. So the implementation time of the new payroll will be a lot less, or you're not going to miss anything.
Right.
Right. So it's just a clean cutoff, nice clean cutoff for payroll. When it comes to, let's say, if you're moving your accounting software, right? You're saying, hey, you're very new, right? If you have everything in Excel, hey, I'm moving from Excel to let's say QuickBooks Online, right? It's nice if you can start at 1/1, clean year, right? And then during that transition of accounting softwares, you look at your chart of accounts, right? And that's when we sit with clients and look, this is a very basic chart of accounts. Here's a chart of accounts that is for your industry, and this will lay the foundation for growth. Now, a QuickBooks Online implementation will happen a lot faster, let's say, than a Sage Intacct implementation.
Right. Some of these things, we might be a little bit too late for if we're looking to really implement some new big ERP. That takes months. Yeah,
I would say 3 months is nice comfortably for a big ERP. Right? You want to start the process 3 months, and if you can, start early, and then by 1/1, the new software, Sage Intacct, will be ready to transact.
Right.
And then you can then transact on 1/1 and then run parallel with your old software.
Just find any bugs and
exactly.
I think we've seen that January 1st for implementation is really helpful. This way, even thinking about policies and procedures internally, hey, we're not this is what we've done this year, as opposed to I've done this through February 12th, and then we all of a sudden flipped on a new piece of software. I think we found that it's helpful to be consistent throughout the fiscal year.
Yeah. And then, when it comes to, let's say, a QuickBooks Online implementation, it's not going to take 3 months, right? It's a pretty quick implementation. It depends, right, on your needs. But then you also have to think about training, right? If your staff is going to be working in the new software, we want to be able to train so you can transact that 1/1. Now, of course, a lot of our clients, they hand off the accounting to us so we can implement and get going a lot sooner. But there's just a lot of things to consider, but now is the time.
Right, a bunch of moving pieces. And to me, I think that's kind of the whole theme of what we've been talking about, and a good way to wrap it up. Making decisions now when there's a little bit of time before the end of the year is the right way to go about it. Let's not wait until middle of January to start taking a look at these things and saying, oh, hey, wouldn't it have been nice? It's hey, we've got a couple months to the end of the year. Let's make sure that we're ready for the end of the year for our accounting cleanup, for our tax filing obligations, for audits, for getting us ready with whatever new vendors we want to implement for next year. Let's talk about it and have those conversations now.
Yeah, absolutely. I mean, just simple things like revisiting estimates that you made. You establish a procedure to create estimates at the beginning of the year, right? Revenue recognition memos. If a product changes slightly, revisit your memo, see how the affects GAAP, right? And you want to start having conversations with your auditors now instead of when the audit takes place. So these are all things that start doing now, and then you'll be in very good shape. Yep.
I think that's a great spot to end it. So really appreciate you being on another episode with us. Yeah. I think a lot of these accounting type items are really helpful to businesses across all industries at really all stages. So I really appreciate you being here for this conversation.
Yeah, Chris, thanks for having me.
Absolutely. And so that brings us to the end of another episode of Wilken & Gutton Plans the Balance Sheet Breakdown. I'm Chris Frederick, and we try to help you make sense of the numbers.